TheoTrade. This is Don Kaufman. It's September 27th, 2019, and you are watching the TheoTrade Weekend Update. So this weekend's theme is on the verge of volatility, and I want to dive right into that. Listen, everything that's happened this past week, the last couple of weeks, just do me a favor. Push it all aside right now. If I have to discuss one more time about repo markets and the Fed not necessarily mattering, I am absolutely gonna lose it. Everything is really going to come down, though, to this next week of trade. And the reason that I kind of themed things this week on the verge of volatility, it has everything to do with correlation coefficients or lack thereof. Now, not everybody is using the term like correlation coefficient on a day-to-day basis in their trading, because most on the kind of retail side, they have tendency to focus like, hey, what do you trade? Like, oh, I'm looking at Apple right now, or I trade the S&P futures, or, oh, Facebook, look at Facebook getting killed, or Tesla, or, you know, we're talking about Beyond Meat burgers. Oh, that's been a big topic of conversation as well. Again, between Beyond Meat and repo markets, I've had enough. But it's all about correlation coefficients, and what you're actually getting, and why I'm calling this the verge of volatility, is the correlation coefficients are extraordinarily low right now. Basically, what I'm saying is this. You have a sector moving up, you have a sector moving down, and because those sectors are moving, inverse to one another, and those are sectors that may often be correlated, it's not allowing the S&P 500 to move in but a rather tight range. And we have expectations that that is about to come to a screeching halt. Of course, everybody wants to know which way, which way? Well, we're going to deliver that a little bit to you here in a moment when we get to a couple of the charts. And again, that's part of the theme over here is the verge of volatility. So this past trading week ended with a little bit of a bang. We had some volatility today, but again, push it all aside. Again, it's all about these correlations. And I'll just give you a quick idea of what I'm really referencing. If you looked at something like the financials right now, I mean, the financials in this marketplace, and we'll look at XLF in a moment, it's the glue of the marketplace. The financials have been rock solid. They're just not backing down. But we all know that the financials are extraordinarily dependent upon what goes on inside of the bond market. Again, I'll come to that in a couple of moments looking at the chart. So the financials are holding steadfast. They're the glue of the marketplace. Meanwhile, we have the technology sector starting to, well, sell off. I mean, we can call it diverge lower, okay? But the correlation between the financials right now and technology is almost non-existent. Throughout the course of the last couple of trading weeks, if you looked at like the S&P 500 advanced decline line or the S&P 100 advanced decline line, listen, whatever floats your boat, you'll see it's like 50 stocks up, 50 stocks down. It's been a veritable slop fest of trade. We're starting to see higher degrees of correlation once again. I mean, what does that really mean? Okay, when we say higher degrees of correlation, listen, when markets get volatile, everything moves cohesively. Everything moves in almost relative tandem, right? So, you know, you get Apple rallying, and that's going to take, you know, Microsoft to the upside, and financials are going with it. We all hold hands, singing the same tune. That is greater degrees of correlation. And in bigger markets that are moving substantially, and specifically the S&P 500, you see correlations upwards of like 87, 88%. In big down trading days, you get correlation coefficients like 93% of all stocks kind of move with the broader S&P 500. And as I said a moment ago, right now we're sitting in what? 50-50 land. I'm telling you, this is what really matters moving forward. And I'm telling you, we're on the verge of those correlations starting to kick back in. So, well, lo and behold, yes, we have a lot coming this next week. Everything, okay, in the past, again, push it aside for a moment. And I'm going to show you precisely why when we start to get into some of the charts and a couple of the trade ideas. And by the way, we're going to get very specific with some key areas of interest in terms of trades moving forward. This next week, we've got jobs report. We've got news flying left and right. You know, we've got trade war to discuss. And there's going to also be what? 20 different tweets that we can't even imagine what are going to come out of. So prepare yourself for the verge of volatility. With that, let's get down to it. A couple of charts, a couple of trade ideas. To the charts and trades we go. Allow me to start here in the S&P 500 E-mini futures. Just taking a look at some of the recent trend, very, very mild to the downside. But the real reason that I am pulling up the E-mini S&Ps is, people, we got ourselves a new gravity point. I just want to highlight it. Be sure to kind of mark it on your chart. 2983. I'm going to say it again, 2983 inside of the S&P futures market, people. That happens to be none other than one of our gravity points. As you can see, we were hugging that gravity point, well, quite extraordinarily until, of course, a very large tweet came out. We got tweeted 20 points off that gravity point in no time at all. But with that, let's get back to the main theme of this kind of weekend's update. It's kind of the verge of volatility. And I kind of talk a little bit about a tale of divergent markets. And I think that the way to explain divergent markets is to show you effectively just that. You know, there's again, infinite numbers of underlyings we could pull up over here. One of the things I like to start with, look at the Nasdaq. Now, I'm all the way down to like a 1 minute chart. So I set up a quick style here. And in this particular style, we could just look at percentages on the week. Listen, bottom line, all that you're looking at right here, right now, okay, is simply the last 5 trading sessions. It's the week. And over to the right-hand side, it's the percentage change on the week. So you can see the Nasdaq, the QQQ, was off just shy of about 2% on the week. Well, what did other major sectors effectively look like? So I've got the monsters of tech listed up here, and the monsters of tech. Now, for those of you that are a little bit newer, that's kind of a conglomerate symbol that I built. It's Facebook plus Apple plus Microsoft plus Google plus Amazon. It's all ratioed together. What do the monsters of tech look like on the week? Off about 2%. All right, so you get it, right? The Nasdaq, the monsters of tech, they're down. Okay, continuing on. Let's take a quick glance at something like energy. Now, if you're not familiar with the XLE, of course, this is our energy sector. Energy, listen, it's been a little bit wild lately. It didn't stop at all this week. Energy down almost, 2.7% of the week, almost a 3% move inside of energy. That's a fairly statistically significant move. And then we start looking at the other side of this. Before I even get to financials, and listen, we can come to the financials in a moment over here. I want to take a look at consumer, staples. All right, this happens to be none other than consumer staples. That includes stuff like Walmart. You realize it's up about 1% on the week. And then we'll take a look at XLY, which is consumer discretionary, down kind of minimally on the week, tune of about 1%. But, net, what did the overall marketplace, when I say the marketplace, what do the spiders do this week? And the spiders, they too were down just about 1% on the week. Now, when I say financials have been kind of the glue in this marketplace, the financials finished the week flat. Okay. Again, as you start to look through this, the divergences are, again, phenomenal. Now, one of the sectors I didn't necessarily bring up that's going to hold a tremendous amount of weight is also utilities. So you see, capital is still flowing into consumer staples. It's still flowing into utilities. Okay. It's defensive. That's what I want to point out. And again, when you start looking at the overall marketplace, it makes sense. The marketplace is kind of locked in a relatively tight range. Although this week kind of started to fall a bit, specifically just today started to see that. It's all about right now these degrees of correlation or lack thereof. Now, I cannot stress this enough. You have a day, specifically today, and the S&Ps were down on the trading session. Here they are. The S&Ps were down. There's a point in time today, the S&Ps actually traded all the way to 2946, which actually was the edge of the expected move. By the way, pretty much to the point, it hit the edge of the expected move. They rallied 20 points off the lows, though. But the point that I want to make with this, during even the depths of some of the sell side activity that we saw today, your advanced decline line, it didn't deviate too much from this. Now, this is why I'm bringing up correlation. It's a really, really dangerous idea right now. The reason I'm saying it's such a dangerous idea, people, the markets right now are moving, and they are moving down ever so slightly down, but they're moving down. If you look at this on a year-to-date percentage, all right, they were up 20%, now they're up 18%. You've had about a 3% slide maybe in the last 2 weeks of trade. Again, it's negligible. A 3% slide, come on, that can happen in one trading session. That's exactly why correlation is a dangerous idea, because this is occurring right now in a marketplace that's like a 50-50 advanced decline line. The point that I make with this, can you imagine a day, okay, where specifically today, if the financials decided to turn around and fall, by the way, look at the financials. They did start falling today and then bid right back up into the close. They actually led the rally. They led us out of what was going to be an other, dire kind of a trading session where the S&Ps were going to be down, 2+%. It was all about the financials. They stabilized the marketplace. And these rotations, they appear right now to be coming to an end. And that is actually why we term this on the verge of volatility, because once we start to get correlated again, those S&Ps, they're going to be all over the place. That's when you're going to have 1% moves, 2% moves, 3% moves on a day-to-day basis. And listen, this is not just me talking. You think the volatility market doesn't see it? Of course it sees it. Volatility market doesn't miss a whole lot. When I was talking about like the volatility market, listen, you look at the volatility futures in a lot of different ways, but one of the ways that I really look at the volatility futures, I look at what's often termed contango and backwardation. And if you take a look, there's 54 days, 82 days. You know that the volatility futures are effectively inverted in the 54 and 82 day time frames. What am I saying? We're in backwardation. That means there's actually more risk 54 days from now than there is 82 days from now, which again, just goes to show you how much risk is still on the table. And if that doesn't do it for you, you could also take a look at something called the VVIX. And I've been pointing this out a lot. This is the VIX of the VIX. It's the volatility of the volatility index. And this thing just will not back off. You got to recognize that, listen, the S&Ps, come on. They are what? A stone's throw off the all-time high. Just go back to the spiders for a second. They're what? They're a week removed. A week removed from the all-time high. And yet we have volatility futures that are still technically inverted. We have the VVIX that's cracked over 100, refuses to back off, and now we're actually facing the idea of correlation. And people ask, well, why is all of this going on? Well, right now, that's why we're terming it the verge of volatility, right? There's a lot of signs that point to traders being nervous. Now, I do not in any way, shape, or form want to be misconstrued in there. I'm going to take a couple of bearish positions here and there, but the bearish positions that I'm going to take, you're not going to see me just like outright, let's get short the S&Ps. I'm being extraordinarily strategic in this case. Like, I don't want anybody to think like I am carrying bearish deltas right now, but again, I am pinpoint accurate in where I'm carrying those bearish deltas. And right now, it's not in the spiders. In fact, for one of the first times I think I've ever had this, I don't have anything on the spiders. Listen, in this particular account, I have nothing on the spiders, and I got all kinds of positions on right now, all kinds of positions on, okay? But I'm carrying nothing inside of the spiders and nothing in the spiders. Continuing on over here, remember, correlation's a dangerous idea. When you wake up one morning and you see 90 stocks on one side or the other, you're going to know. And we're not going to go back after that. Once we actually get correlated, okay, it's on. And you better remember that. And that's why I'm saying this is the verge of volatility, because we saw degrees of correlation start to pick up and then rapidly abate as today's trading session went on. So remember, financials, they're the glue behind this marketplace, which actually brings me to, here we go, bonds. They're poised to drive the next equity move. So even though I said that financials are the glue inside of the S&P 500, but it's bonds that are really going to drive that move. Okay. Bonds here, people, this is a completely and total binary trade. What does binary trade mean? This is a coin flip. Listen, there are times where I'm hot in markets. There are times I'm cold in markets. And there's times you look at a chart like this, you can't find the front door in your own house kind of cold. This is all about order flow at this point. If you think you know the next move in the bonds, I'm telling you, you're wrong. Okay, the bonds are all about order flow. If we start to trade a little bit higher, then all the sovereignties are going to come in and start to flow more capital into the U.S. If the bonds start to head lower, listen, why would the bonds ever sell off? Because if the bonds sell off, that means interest rates are going up. I'll tell you why the bonds will sell off. Because people want to take some profits. every major institution out there, including Jamie Dimon and JP Morgan, they're all long the bonds. They're all long the bonds. So who cares that they're long the bonds? I do. Because look at the profitability they've had. Forget about interest rates. Nobody cares. Nobody cares about rates. We all know that the Fed is going to, cough up their proverbial cookies in the next, 9 months or so. Interest rates are going back to zero. That's short duration interest rates are going back to zero. We've already figured out that they're going to kick on quantitative easing. The Fed is no more. These bonds, though, in the meantime, their trade is free. Okay, they can do whatever they want. And I'm telling you right now, when you're sitting on those kind of gains, right, you don't have to be the first one out the door, but you definitely can't be the last one. So to see some sell side activity in here would get wicked. Just wicked. That would initially spark the market to rally. That would rally the S&P 500s with a big sell-off inside of the bond market. If the bond market got too extreme, there's an inflection point. If this thing started to sell off, it too would actually drag the S&Ps down. But on the flip side of that, and again, this is the big binary decision of the verge of volatility, the flip side, if we start to rally back on the bonds, well, we would probably start to rally back on the bonds due to Chinese-U.S. relations, trade war. If people start to get nervous, when they get nervous about markets, they'll start to throw capital towards the bonds. It's not just U.S. traders. This is actually individual sovereignties. I mean, why not? Japan, come on, throw some money into the 30-year treasury. They just print money and then bring it over here. They have negatively yielding interest rates. What do they care? Print money, bring it over here. It doesn't cost them anything. It's a party. So the bonds are, at this point, it's all about order flow. It's complete and total free-for-all. And I'm telling you, unfortunately, this is the move, though, it's poised to drive the next equity move, meaning that the move in the bonds is going to drive what happens in the entire S&P 500. Next on the docket, risk twist. That's RTS spreads and volatility. We have an issue. We have markets sitting near all-time highs, right? But at the same time, I can't go out and do my kind of, marquee risk, shot. And that is, I like to go out, sometimes all the way out into January here, and I'll just open up every single strike, make sure Delta's on the screen, and I'll create one really quick. Listen, maybe we'll go out and sell those 90s, buy, 1, 2, 3 of these monkeys, sell one of these. Look at this thing. It's going for $4.10. Okay. This trade is normally sitting right around what? About $1.60. Right now it's going for $4.10. Forget it. I can't do the risk twist spread. I can't do it in the spiders. So I've been forced to get innovative and do this trade in places like TLT. Okay. Why TLT? Well, why not? The bonds are the ones poised to make the big move, so I might as well just trade them. You can actually see I've got not just a risk twist on the call side, but I've also got a back ratio on the put side of it. That actually creates what we term, okay, the mighty infinity spread. Ooh, it's a smile. Okay. That's the infinity spread, and it's on inside of the TLT. I'm also experimenting with infinity spreads inside of GLD. This is one I've played around with a little bit. Okay, these have inverted volatility skews. If you're not up to speed on that, check back with us. Of course, there are classes, highly detailed classes on all of this here at TheoTrade. Now, back over to my scratch pad. So that's a little bit of risk twists and volatility. Next, stocks ETS of interest. Well, let me show you what's interesting to me right now. Let us start with the Facebook. Okay, the Facebook, it doesn't look like much, but this is one that's had some pretty extraordinary sell-side activity. And we start looking at it on a year-to-date basis, it's still up 30%. But here's what actually gets me. Take a look at like the auto expected moves. Okay, Facebook, it's smashed through its expected move. And this thing this week started at 190 and ended the week. Okay, again, started at 190 in the week and ended the week at 177. It's a fairly extraordinary move. In fact, we always like to talk about what we term statistical significance. It was up 40%. Now it's up only 30%. That's corrective action inside of Facebook. Keep it in mind. I'm not ready to place a position in here, but a breakdown in Facebook, it's just going to suck all the monsters of tech right there with it. Next one I want to look at is one that I'm actually carrying positions in. It's none other than Starbucks. Starbucks, a very similar boat. If we look at it in terms of auto expected moves, Starbucks actually touched into the edge of the expected move. It is a fairly significant move. Listen, nothing I'm going to do in Starbucks right now other than sit tight. Let it come to you. You can see I've actually carrying a duration position. Again, I'm carrying a duration position. Effectively what I'm saying, I'm just outright short Starbucks. This is possibly the beginning of a larger breakdown. Clearly, there's earnings ahead of us. That's going to impact us. But again, between now and what? Earnings, you got a month in here. Okay, not earnings are going to save us. Look for some more sell side activity, possibly inside of Starbucks in the near term. Another one I've actually got positions in, and I'm watching very carefully. Costco, really similar situation to what you're seeing in Starbucks. Okay, however, Costco, it's got earnings right here, right now. It's coming next week, and that's exactly why I wanted to bring it up. I'm still carrying duration positions in here. Now, I am short Costco. I want to make that clear. I would not consider going short Costco right now. Let the earnings come out. Let's actually play ball in there. Again, Costco, though, breaking down. What I'm looking at, though, between Starbucks, Costco, these are some really key kind of reversals. I mean, this 307, hey, but don't get me wrong. Earnings come out. Look what earnings are pricing. A $14 move. A $14 move is being priced in Costco for next week. That's put your big boy pants on, because that's a sizable move inside of Costco. All right, next one on the docket over here. Here's one where I feel very strongly about. There's not a day goes by where I don't mention Jamie Dimon. Maybe a little dig on there. Anyway, this is one in terms of financials. If you're looking to get short financials, it's not necessarily the XLF. I like the JP Morgan. Now there's earnings coming out. So if you're going to take a position in here, it would have to be rather shorter duration. Or you could actually pull off what I'm doing. This is called a duration position. I'm using a deep in the money put as a synthetic short position inside of JP Morgan. Net. People, I'm just going to tell you right now, I want to be short in JP Morgan. Okay. Listen, you tell me what's going the right way for the financials. Okay, what's going the right way? Other than the stock is bid up right now, other than quantitative easing, QE might come back. Yeah, but rates, they're going to zero. Okay, rates are going to zero. And how are the European banks functioning in that? They're doing terribly. All the European banks are 20-plus year lows. I expect JP Morgan to take a fairly substantial hit, but that's not going to happen overnight. Moving on, XHB. Okay, a lot of the same reasoning inside of XHB. The home builders, okay, my bottom line in home builders, I'm already carrying positions in here. Too far, too fast. I mean, realize the home builders are up 32% on a year-to-date basis, and we're talking about recession. Okay, that one is easy enough. Okay, it's nothing more than, hey, it's a recessionary, tale. If that's going to play out, of course they're going to hit the home builders sooner or later, regardless of what interest rates happen to be. Here's one I'm not necessarily interested in taking a trade in right now, but I just wanted to bring it up. The utilities, you saw me bring it up earlier. Okay, since when are utilities outperforming the S&P 500? Utilities, it's one of the top performing sectors basically out there. Think about that for a second. You got issues when utilities are outperforming. Okay, let me just throw this up here for you. Yeah, they're outperforming Amazon. They're outperforming, your Googles. They're outperforming what? I have to sit here and compare utilities? Like, really? I'm comparing utilities right now to tech stocks. Okay, Microsoft, Google. That's where we're at. I mean, Microsoft is outperforming, the XLU, but that's the kind of thing that, you have to think twice about. Next one, Altria Group. I am now long Altria Group. Why am I long Altria Group? Listen, I don't want emails from people about Don buying a smoking stock over here. It has nothing to do with that and everything to do with the fact that it's an 8.37 dividend. That's the yield on it. I am going out. I am selling puts to get long stock. Okay, I've also gone out and purchased a few hundred shares of the stock outright. I'll sell calls on it. I mean, listen, the stock could decline another 10%, another 10%. 8% of that I'm going to get back, in dividend. But so if the stock declined another 10% in a year, like year over year, I'll be okay because I'm collecting a little bit of dividend. And then I'm going to go out and I'm going to sell a couple of puts to get long more stock. And then I'm going to sell way out of the money calls and collect even more premium. I mean, the only way I'm really going to get damaged in Altria Group is with a 20 or 30% decline. And even then, okay, even if they cut the dividend, I'm not going to be in tears over this one. Next one on the docket, SLV. In terms of SLV, this is silver. Silver's actually taken quite the hit lately. Okay, all I'm going to do is just a quick in-out spread to the upside. That in-out spread is 28 days out. Buying one strike in the money, selling one strike out of the money. Because the underlying is a $16 underlying, I did a $1 wide spread inside of SLV. Last but not least, XLF. I brought up XLF just in case you were not comfortable with JP Morgan. You're like, I'm scared of shorting Jamie Dimon. Why? It's fun. The XLF, if you wanted to get short, like synthetically short, You can avoid earnings. You can just come out 35 days using in-out spread. This is like a $2 wide in-out spread, some 35 days out. Or if you really wanted to establish a more substantial position, you can come right into here and do a little bit more of a duration style position using an in-the-money put as a synthetic stock replacement. What else do we have to look forward to this week? Trade war. Of course, China will meet the U.S. It's late in the week. I'm not even sure we're going to get any news on it. So you've got that to look forward to and all the tweets leading up to it. But net, what does this mean for risk? As I said, we kicked this off. We said the verge of volatility. So what does the verge of volatility really look like? Well, one of the things that you got to recognize when I'm talking about the verge of volatility, I bring up every chart in the world. Listen, all you really have to look at is the expected move. Okay, I talk about these things again incessantly. You can see we literally tagged the edge of the expected move to the penny today. That was today's trading session right here on Friday, September 27th. Next week's expected move, they widened it out. What are you looking at? Okay, well, I'll tell you exactly what we're looking at in terms of an expected move. $54, okay, $54 and change. Again, 54.67 to be specific. In the next 7 days, the previous week, we had about a $47 expected move and we tagged the edge of it. Now we're looking at almost a $55 move. Get ready to rumble. Again, there's a whole lot of volatility out there. It's all about the idea, though, of correlation. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.